Good day, everyone, and welcome to Admiral Markets and Forex 3 joint webinar. Today, we will talk about new patterns in Forex trading, maybe some patterns that you haven't heard of, and some exclusive patterns that usually show during your trading day or trading week. These new patterns, some of you maybe have heard of it. Some people probably don't know anything about it because there are some patterns that I personally have spotted and created, if I can say it, like T89 pattern or low volatility zone. So yeah, here we will see actually what we have, and this is very useful because these patterns will usually appear on your intraday time frames, and very often they can be spotted even on higher time frames. But mostly we use it as a confluence, as a tool for a confluence to make entry decisions or continuation of our trades. Before I begin, as always, our standard disclaimer explain that online education materials are available by Admiral Markets Estonia for a global audience. So take into consideration the information session is not suitable for everyone. Admiral Markets Utility takes no responsibility for information accuracy. So this represents the personal opinion of me, and in no way it represents the actual suggestion for a trade. So this webinar is for informational and educational purposes only. By accepting this risk disclaimer, you're also proceeding further with me. So today we will talk about Adam and Adam, rounding tops and bottoms, T89, Levez, low volatility zone, running shapes, volatility spikes, order blocks. This is very, very, very important, guys. And maybe if you follow me and my analysis, especially, you will see that order blocks are very, very, very strong. Remember Australian dollar yen trade yesterday that provided us with really huge amount of pips. So almost every single of my analysis also has order blocks in it. Historical versus now moment buyers and sellers, hook reversals, and V-shapes or diving boards. So let's start first with standard patterns. We will not be going too deeply into this pattern and all these patterns. I mean, those are all standard patterns that you probably know of. We don't need to repeat ourselves always. Same head and shoulders, rectangle channels. I mean, even babies in trading know about this. I mean, everyone knows about head and shoulders, pennants, and so on. So this is just to see that there are also standard patterns that we use, but they are not always treated the same. I will just mention one example. For example, standard price action school and price action teaching will tell you that you should go short at the neckline break, right, of head and shoulders. This is what you will see 99% across the internet, and 99% of teachers and educators will tell you that you should go short when neckline breaks. Well, I personally am not teaching you to do that. My teaching and my education is short it here, short it at the top of the right shoulder, not at the neckline break. Because if you shorted it or here, then it would mean that you would be late in a trade. You want to go with institutional sellers on this one, not with retail sellers. And institutional sellers usually will sell off from the top of right shoulder. You might wait for a confirmation of the right shoulder to be made, like let's say 2 double tops bottoms on shorter time frames, but the overall picture should remain the same. So let's say that you have head and shoulders formed on a 1 hour time frame. You can zoom into 4 hour lower time frame, that is 15 minutes, and search for entry. That will be at the top of the right shoulder on 1 hour time frame. It's multiple time frame approach. We already talked about it, but just to let you know that this is very, very, very important, guys. If you take a trade on head and shoulders here at the top of right shoulder, you will be joining institutional sellers, and you will be pretty much early in your trade. Neckline breaks usually, I mean, when market is volatile, they can give you a good breakout, but problem is that if you don't see a retest usually that breakout, initial breakout, is not that big, and it can spike out your stop loss, whatever, if it gets back in the range. So that's also very, very, very good to know. So that is about head and shoulders. Same is for inverted head and shoulders. Okay, so inverted head and shoulders is also very good. And one thing about wedges, a lot of people usually ask me, do I think that wedges are very good to actually trade or spot? I would say treat wedge as basically as a triangle, because it is a wedge, but in its rough shape, it's a sort of consolidation, pre-consolidation before breakout. So we are actually waiting for the breakout. So there is nothing strange, nothing new in these wedges, except we treat it as breakout. So we can actually trade it as a trigger happy trade, breakout retest, or breakout pullback continuation. Okay, so that is about the standard patterns. So my primary focus was on head and shoulders and inverted head and shoulders, to let you know that always try to find entries at the top of the right shoulder, or in the case of inverted head and shoulders, at the bottom of the right shoulder. So that will ensure you're pretty much early in the trade when institutions also buy and sell. So here, you know, this is standard teaching, also broadening wedges, guys. We won't be mentioning broadening wedges in any tradable environment, because I don't like to trade megaphons, broadening tops, broadening wedges. I don't like it personally, especially when it comes to a megaphone pattern, broadening top, some call it. I mean, it means that that the price action is actually, that there is not clear direction, and the price action is going from congestion phase into a higher congestion phase. That is a broadening top, and I never ever take any trades, or I don't do any analysis with broadening top on the chart. I don't like it. These patterns are also they're also within the domain of standard patterns, such as scallops, flags, double bottoms, double tops. But let's talk about one of my favorite patterns, that is Adam and Adam bullish pattern. The main thing between W and Adam is that Adam has wicks. Okay, so it has wicks. This is the perfect example of Adam and Adam. This is Adam and Adam in its sense, because it has wicks here. But guys, you know what wicks mean? Wicks mean that there are buyers here. Okay, here we see buyers. Here we see buyers, right? Standard W-shaped patterns do not show you wicks. And how I teach people to trade is that wicks are more important than bodies. Why? Because wicks exactly tell you everything about now moment versus historical moment. And that is very important, guys, because if you go to the left, for example, on your chart, and if you find historical buyers from the same spot, Adam and Adam wicks appeared, it means that a chance that the price will be rejected from this zone is high. The chance is very, very high, because in the history, if you saw that this pattern appeared, or just buyers were there, there is very strong chance that buyers will also appear in now moment and will reject the price above its breakout point. So I personally prefer Adam and Adam better than W standard. And when I see this, I don't even wait for this point, because this is 1, 2, 3, right? And if point 2 is broken, we usually go long, right? But when I see this, guys, and let's say I just need one more confirmation, and that is confluence. If I see a pivot point here, or important support here, or anything that will give me just one more confluence point, I tend to go long immediately, even not waiting price to break 0.2, because this usually can be identified as the beginning of Adam and Adam. But for all of you who are not experienced in trading, I would suggest that you wait for 0.2 to break and then take a trade. By over the time, you will actually gain some experience and you will be able to trade this even without a confirmation from 0.2 breakout. So here, when you see this happening, okay, just wait for another possible confluence point or zone, because your risk to reward will be enormously higher than if you actually waited for breakout of 0.2. If you see this, then really, guys, you're on a good way to hold your trade, because it will be a breakout. So Adam and Adam, I really liked it. Rounding top, well, let me just, yeah, the rounding top. It usually appears at resistance, and that is why it's called a rounding top. I personally try to spot it only at important historical resistance levels. It's not that you cannot see it on other resistance, but if you know that there is some important resistance there, well, this will actually give additional strength to rounding top. And the characteristic of this pattern is that price form a gentle curve at resistance. Okay, so when you see a gentle curve at resistance, and that it sometimes it resembles something like a rooftop or head and shoulders at resistance, but you will actually be comparing wicks again. So this is wick, this is wick, this is also wick. So these are most prominent wicks. And if you imagine some sort of rounding shape at the top, or you just can connect it like this, you can connect these tops. Let me erase this. So if you actually connect these tops, you will be also able to see that this is a form of rounding top, and the price will probably break. Now, what is the confirmation of this pattern? It's a simple trend line break. So when you see that this pattern has been formed, you just wait for a trend line break. In this case, this is trigger happy, this is retest, and below this point, actually we have a continuation trade. I don't personally prefer and like to trade breakout, pullback, continuation on lower time frames, simply because you will be in a big drawdown if it takes a lot of time to actually confirm the retest. In this case, let's say this was indeed a breakout here, and you see there was a retest, continuation happened here, but there was another retest. So I personally treat these kind of patterns as a cue that the price will actually continue or start to go in bearish direction. So if I see this, I might take a trigger happy trade, but then I will be fast with hit and run. Then I will wait for a retest, and if I see a continuation, this will be additional information that the trend on a particular time frame is bearish. I usually, you will see that my analysis is usually 1 hour time frame, but I always take a look at 4 hour time frame, and very occasionally a daily time frame, because daily time frame gives me a trend on general trend. 4 hour gives me retracement, 1 hour gives me entry. Guys, if you want to listen to me, if you want to have profitable system, then try to trade with multiple time frame trading. You don't need a system, you just need to actually watch different time frames, usually 4 hour, hour and hourly charts, or daily 4 hour and hourly charts. That will be really more than enough for you to pick up good entries. Especially if you follow me and my teaching, you will see and you can find a lot of live training videos, I personally always take multiple time frames in consideration, because you want to piggyback momentum from higher time frames, and you actually cherry pick your entries at lower time frames. That is what I find. I really find it much better than trading one simple time frame, because one simple time frame has only trend. You want to see both trend, momentum, and retracement. With that, you need to use multiple time frame analysis. So, for example, you saw this on 15-minute time frame, and now if you zoom in on 5-minute time frame, you will be able to spot entries. So you need retracement, you enter on retracement, and then you actually ride momentum on higher time frame and trend, that is on 15-minute time frame. So the main purpose of this, to spot your trend and make an entry based on trend. And I advise you to do on multiple time frame, always zooming in into lower time frames to find an entry based on a trend on higher time frames. So once more, if we see this on 15-minute time frame, we would zoom into 5-minute time frame, wait for retracement, and then enter, because you always sell high, or when price is overbought. If you want to sell, you always buy low, or when price is oversold, to go long. But that is your entry time frame. Your trend should be on higher time frames. And if you listen to this advice, I'm sure that you will find much better entries than with trading on one simple time frame. T89 is my personally developed pattern, and it's actually EMA 89 with spike candle. Spike candles are usually pin candles that signify now moment buyers and sellers, depending on your entry. In this example, we can see that this is actually buying of T89 pattern. So in order for T89 to appear, you need to have EMA 89 set on close on your chart, and you need to spot a pin bar rejection of EMA 89. Body of the candle is not very important. More important is this big wick, because in many occasions you will see that body is bearish but wick is bullish, like this example. And here actually you will see that both bodies and candles are bullish. Here body is bearish, candle is bullish, but you see it was more than enough to spike the price from T89. T89 can appear on any time frame. As I say, go with multiple time frame analysis, finding a trend and the pattern on higher time frame, and zooming into lower time frame to actually trade it. Confirmation for the entry is when the high of T89 pattern is broken by 2 pips. Okay, so you need to zoom into lower time frames, find a confluence of confirmation when high is broken by 2 pips, and trade it. But very occasionally, if I spot it on 4-hour time frame, I don't trade it on 4-hour time frame, but I rather use it as a confluence spot for 1-hour entry. So if I see that this is actually T89 on 4-hour time frame, I would zoom into 1-hour time frame and search for entries there, because this will usually tell me that price will reject and it will actually change direction. This is good, because if we know that this is a bullish trend, and indeed it is, because EMA also serves as a dynamic trend line here, you will know that this was actually retracement. Retracement has ended and we can go for another long entry. It will ensure that we are buying low, guys, because T89 will usually appear on the support, or when price drops, losing its momentum, on long trends. And if you see T89 at resistance, it means the price actually has gone too far and it will start to drop. Usually it can be found also on bearish trends. So use it as a trend confirmation and also as a tool for your possible entry into market. Low volatility zone is something that I also like to see. I call it Levez, because low volatility zone is spotted at the same time where historical buyers and sellers appear. So historical support or resistance versus now moment. Notice the price indecision. So let's say that we are here. We take a look to the left and we see that in the history there was strong buying from this zone. And now we are seeing indecision. What it tells me is that the price is congesting here and that we might expect a breakout in the same direction as it was previously shown. So here in the near-term history, we saw a huge spike of the bottom, and in now moment, we see indecision. Indecision is low volatility. You see these candles. Every single candle is not that big, it's not that high. Guys, it's like the price is indecisive. It goes like this. It doesn't know where to go. But what we do, we are waiting for a confirmation of the breakout in the same direction as it was previously shown. So here, this was breakout, and now we can expect breakout from here. So this can also be served as an entry and also as confirmation that the trend might probably reverse if we see something like this. If we see that this is, let's say, 4-hour or 1-hour time frame, the price is in downtrend, right? This is downtrend. And here the price was reversing. So we might expect, so this can be served as counter trend trade opportunity, or just a cue that you can exit your trades if you're actually short. Because here, if there is a breakout, go long or exit your short trades. Running shapes. What is different between triangle or a running triangle? The only thing that is different is that running triangles, they simply do not have vortex. You don't see a vortex here. You don't see a vortex here. Running triangle, running wedge, okay, something that actually it was formed, or it has been forming in now moment, and you expect a breakout. So this is very important. When you see running shape and you see a breakout, it will usually mean that there will be no consolidation anymore, and that breakout is actually happening. Volatility spikes, those are unusual spikes due to some news, events, or rumors. Guys, this is very important for you to know and you to see, because when this happens, this is a fake out. Fake out. And fake out can be also tradable. So here you see spike, but before the spike, there was actually a downtrend here, right? So in now moment, if you see this, and you know that this is, there are some news or maybe some sort of event or rumor, wait. You don't trade. You need to wait. Because usually after that, there will be movement in the same direction. This was spike, but then you see the price continued in the trend direction. This is used for institutional buyers to usually enter another sell. Retail traders might go long, but this was wrong, because this was just a spike, fake out. And that fake out is actually, this is very, guys, very, very important for you to know that this fake out can also be traded. Wait for the price to settle. And if you see that, let's say in this example, fake out high is this. This is fake out high. If you see that this fake out high is not broken, just wait for this low to break, and this is another confirmation for you to go short. But if you go long immediately after this, the chances that you will be stopped out. Because usually after some unusual spikes or rumors, price continues to go in the trend direction. My favorite pattern, my favorite tool that I use for trading, for analysis, is bearish and bullish order block. Bearish order block is the low of bullish candle prior to move down. But those bearish order blocks can be found when you take a look to the left. I will show you this, especially this on live chart when I finish with PPT, so you will be able to see what it is. So just for now moment, remember that the low of bullish candle prior to move down is called bearish order block. Sometimes the body of the candle can also be bearish, but I will show that in real example, so you will also know what I'm talking about. Bullish order block is the high of a bearish candle prior to move up. This high is order block, and usually these order blocks are very, very extremely good in showing you potential trade setups and confluence points for you to take trades in trend direction. I really like to see bullish and bearish order blocks. Hook reversal tops. Well, this is just a reversal pattern that appears at resistance. When you see that the price is going up, you will usually see a rectangle consolidation after that and a breakout of rectangle consolidation. So it looks like this roughly. This is very similar to rounding top. So this is a cue that the price will probably reverse. It's classic hook reversal pattern of resistance. Same for reversal bottom. Price has been dropping, then it has been forming a consolidation form of a rectangle or consolidation pattern, and it goes up. It roughly looks like this. Very similar to rounding bottom. Cup with handle, these patterns, some people know this pattern. Actually, this is bullish pattern. First, you see that U shape has been formed at the bottom, and then you see a rectangle consolidation just after U shape has been formed. What you do is, this can be a cue for you that the price will continue to go up, but if you want to trade it, you need to wait for the break of handle. When handle is broken, I mean, I taught you to trade trade breakouts in three different ways. Those are trigger happy trades, breakout, retest, breakout, pullback, continuation. That is discretionary how you will trade it, but you can trade it after handle breaks. Cup and handle is bullish pattern, so you need to wait for top of the handle to break. If it doesn't break, if it indeed breaks the bottom, then cup and handle is invalid, so you don't trade it. V-shaped reversal or diving board is a reversal pattern. I don't trade it, but I usually take a look at it in the form of reversal pattern that give me cue that the price is going to reverse. So I personally don't take any special attention to it, except that I want to see a V-shaped reversal, and then I might decide that trend either change or not. The trend change is usually if we see V-shaped reversal and the break of the top. So you see consolidation, then the price drops, you see a V-shape, and if this top is broken, we might say that the trend is going to reverse. So this is just a cue for me that trend change is about to begin and that we might start looking for long trade opportunities instead of this. Okay. Okay, we covered this. Now let me open my live chart and show you first order blocks. So euro dollar, for example, guys, let's use, I don't know, we can use whatever we want, but let's say this one. Okay, you see, guys, when you open your chart, you need to see the trend. General trend on euro dollar is to the downside, right? So if you take a look to the left, you will see most prominent swing. So this is actually, you see, this is bullish, this is bearish candle. But if you see this most prominent swing here, take a look at this. Let me zoom in. You see, the price has formed a swing, but in now moment, if this is now moment, okay, see, it went down. In now moment, I might say this is bearish order block, okay, bearish order block here. And here, it doesn't mean that the price body needs to be bullish, but it's very, very, very obvious. So watch what happened. Rejection, 3 consecutive rejection, 3 consecutive rejections. And watch this. So what I think is, if the price breaks this, retests, and goes down again, I mean, if it retests this, it doesn't break it, it can go down again. You will find a lot of these examples, guys, on any, watch this, for example. Let's see, even this one, it was too big, but watch what happened. Here, actually, price made one more try before going down. Okay, here also, price made another attempt to go up. And usually these order blocks will be very, 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 very strong. Here, when trend is about to begin, you will find that these order blocks are very strong. Watch this. The height of this, well, we have double top. So both highs of these bullish and bearish candles are actually order blocks. Price goes here. Watch this. It goes above this order block, retests this order block, perfect retest, and goes up. Watch this. Almost perfect retest. So order blocks are always found to the left. So if you see that the price is retracing, watch to the left and see if there is order block. The chances that order block will give you at least scalping trade. The question that I see from YouTube, every successful trader uses multiple time frames. Can you use for 15-minute time frame? Yes. If you use 15-minute time frame as multiple time frame, you need to scan 4 hours for trend. So this is bullish trend. 1 hour for retracement. Okay, this is retracement. And 15-minute, actually, you want to see, this is confirmation, probably here, this spike that the trend will go in, that it might go up. So 4 hour, 1 hour, 15-minute, if you go with multiple time frame. I personally use 15-minute, 5-minute, 1-minute for trading new spikes. But I think we might leave this for another webinar, because we don't have the time to talk how you do multiple time frame analysis. So I think I will schedule a next webinar with Forex Street for December, and then I will do that, and I will actually explain how you can trade with multiple time frame analysis. Yeah, but definitely, guys, you need to watch for these order blocks, because these order blocks, those are also very important for multiple time frame analysis. Okay, very important. You can do that for every pair. This is price action, so it doesn't depend on any pair. I mean, it doesn't depend on anything. It's just simple tool to show you good confluence spots. You need, however, to find trending pairs, because this is most useful when you see that pair is trending. These are order blocks here, guys. See here, order block here, also here, order block, if you watch it at now moment. Now, if you see that the price is actually going down on Eurode, so this is bearish, right? 1 hour is also bearish, but watch this. This order block has been retested. Watch this. Classic definition of order block tells us that bearish order block is the low of bullish candle prior to move down. But watch this, guys. What happened is retest down, almost a retest, but it's very close, 1-2 pip down. Watch this, it's been rejected. So order blocks, so important. So please take a look at my analysis, and you will find order blocks usually drawn with this dotted lines. So you will find even more examples on my analysis with dotted line, and I usually write this is order block. So you will have a better idea of what I'm talking about. Watch this, guys. This, what happened here is, see, again rejections, and you use it as a confluence for potential trades. One more thing that I wanted to show you is, okay, doesn't matter. You go here, indicators, you go with moving average, and put 89, exponential close, okay, and yeah, it doesn't look good. I need to put a line here, okay, like this. And T89, it can appear on any time frame. If it appears on higher time frames, it's a cue for you that the price will continue in that direction. On lower time frames, it can be used for entry. This is T89, guys. This one is T89. Perfect example of T89. Okay, watch this. T89, T89. This is not T89 because of the wick. If this is also, it was very close, but watch. So you want to see rejection, pin bar rejection, okay? You want to see that pin bar rejection, okay? Usually, you see, this is sign, this is bearish body, but wick is bullish. And what happened is the price went up after this. It went to retest this, but it went up subsequently. Okay, watch this. Body is bullish, but wick is bearish, and it rejects 89. It went down, you see? Watch this, same, went down. Double, watch this, double T89. Oh, this is no-brainer here. No-brainer. So many good rejections. Watch this. Bearish, completely bearish. So take a look at this. I mean, maybe that is something new. Maybe you don't like to trade price action. But guys, I like price action, really. And even though if you trade with indicators, price action can tell you additional things that cannot be spotted by simply indicator trading. So take a look at this. It might be very useful to you. And if you have any questions, you can ask me and send me an email. I will be glad to answer you. But do not stray away from this, because it might boost your success ratio in finding good entries and trading opportunities. If you have any questions, guys, you can ask me now. I will answer it. If you don't, well, we can call it a day. And, well, we can be ready for next week, I guess. Today is profit taking, so you will see a lot of counter trend moves. Don't be afraid, because Friday is always profit taking day, and especially because now we are actually getting close. We are getting close to London noon, and London noon is usually when London profit taking takes place, and we will see another spike in volatility when New York traders get in. So I don't see any questions. So thank you guys for listening. As I say, if you have any questions, any doubts, whatever, just send me an email and I will answer you. Thank you for your time. Thank you for your comments and questions, and talk to you soon. Cheers, guys. Trade safe.